we are living in a different time right now, and presenting your company is always fun and exciting. I did have a business at one time that I raised capital for about 8 years ago. So I've been on your side of the table. I understand what it's like to be there, and how passionate you can be about your business, and how challenging sometimes it can be to actually bring those dollars in the door. So we're going to be running through some different things today on just what I've learned over the years, and then focusing not so much on, you know, the story that you tell, but more the content and the psychology that actually goes with presenting to individual investors. So who am I, and why am I doing this? So I am Brianna McDonald, and I'm the president for Keiretsu Forum Northwest. I have been involved with Keiretsu Forum since 2005 and wrote my first check for a company in 2006. So I've been listening to pitches for 15 years. And when I first came to the table at a very, young age of 25, I'd sit and listen to these pitches, and with a bunch of men in the room, old men, and I'd listen to these companies, and I'd be like, what is your business, and how do you make money, and what is your product? And I would think, I'm not meant to be here. I don't understand this. And then I'd listen to the investors ask the same thing. And I realized that it wasn't me. It was that the presenter actually wasn't conveying their value proposition in a way that we understood it. And so after about 15 years of listening to all of those horrible pitches and not understanding what entrepreneurs do, but knowing that you have a really good business, I decided to start doing these presentation trainings to really help bring together the two of what the investors are looking for, and why, and what you're doing, and why it's important to you.
Brianna, can I interrupt?
Yeah.
Is this deck available then at the end, or a recording?
The deck is not available, but the recording will be.
Thank you.
So just really quick on who we are. So Keiretsu Forum is the largest, most active investment group in the world. We have over 55 chapters across 13 countries and 3 continents. We have been the most active early stage funder for the last 4 years running in PitchBook. We fund a very special area, especially here in the Pacific Northwest. And I will define that this funding gap as really this growth capital. It's usually companies raising between 500 to 5 million, although I will say we do see companies raising as much as 10 million and help support that effort, tranche it out a little bit like what Terrence was talking about. So this is where we focus, and it's our sweet spot. Keeping in mind, there's 2 different tracks up on this deck. So you have kind of the pre-seed, the startup, and then this funding gap getting into the growth capital. And then you have the VC route. So you can really choose to go as an entrepreneur. Who do you want to be bringing in as your investors? Who are the most important for that stage and growth of your company? And keeping in mind, looking at the numbers at the bottom here, that 2.23 billion went into 66,000 deals in 2018 from early stage investors, whereas 130 billion, which is a ginormous number, went into under 9,000 deals on the VC route. So it's a very different funding methodology. There's different expertise, there's more control, there's different things that come with it. So understanding that those VCs, it is a certain track. And if you are preparing to go that way, that's fine. But there are other methodologies you can take in terms of raising capital for your business to have the outcome that best fits you and why you're working so hard on this venture. So as I mentioned, Keiretsu Forum, we've been the most active the last 4 years running in PitchBook. Last year was no different. We were the most active in early stage funding, as well as most active in late stage funding, really getting into those B and those C rounds of funding for our companies. And we have, great organizations we're up on this leaderboard with: Andreessen Horowitz, 500 Startups, Northwest Venture Partners. So, we continue to be very active, especially during COVID. It's actually provided a reduction in barriers in terms of access of investors, which has been very beneficial for the entrepreneurs we're serving. So on the global front, we do have our chapter president here joining in from Istanbul. In the world, we came in as number 2. just under 500 startups, but once again, number one in that late stage funding. So, you know, one thing that I just want you to take from this is you have to know where you're going and who your audience is as you go out and pitch your company. So there are those groups that do that early first money in, and there's groups that do seed funding. We tend to be a little bit more later stage, Series A, B, and C, and that's a lot of what we fund here in the Northwest. Not every chapter is different, but make sure you know your audience and who the investors are and what their focus is as you look to raise capital. It'll be less frustrating for you. It'll be less frustrating for the investors you're pitching to. So a little bit of what we fund. Last year in the Northwest, we put 54 million into 83 opportunities. We saw 102 come through our process, with the majority of that being in technology and life science. We do have some consumer, clean tech, and a little bit of real estate to diversify it out. Primarily though, we're looking at technology, both software, hardware, different types of tech, fintech to take us forward, and then life science. It is medical devices, pharmaceuticals, therapeutics, all of that fits into the life science category. And just really quick on our investment process, it is structured and it is run by our investors. So we do have committees, with the most active being our life science and our technology committee, no surprise there. And they review the opportunities at the beginning of the month, as well as I'm on today with my deputy entrepreneur director, Amber Cannon. So she might be chatting with you during the meeting. She helps to get those pre-screening emails out and get those qualifications met. So about 30 to 50 companies reach out to us every month, of which only 7 or 8, I mean, this says 10. During COVID, we've seen about 7 or 8 deals each month at deal screening. And so our members then choose who moves on to our forum meetings. We have 6 meetings that occur every month that you pitch in different areas right now, all virtually, of course. So people sign in from all over, which is great. But we host 6 different meetings, 2 in the Rockies region and then 4 in the Northwest region. And then from there, we have a full-time due diligence director, and you move into the due diligence process. And if you do well, raise capital from the Keiretsu investors, get due diligence complete, you can apply to the Keiretsu Capital Fund for a top-off round. All right, enough about what the organization is and how that all works. Let's get into creating a fundable pitch. And the big takeaway here is it's not actually about your pitch that raises capital. You are the reason why you raise capital. So the pitch is just to generate interest. That is the whole goal. And I tell you, when you're setting milestones for yourself, because you're running this marathon to be able to go out and raise that capital, being able to have a little incremental steps that you're taking and achieve those goals is much easier than being like, oh, I got to go out and raise $4 million. That is a mountain to climb. But if you go into a meeting and all you need to do is bring on 10 individuals that you think would be interested in your deal, and that's your goal, is to get 10 phone calls set up. That's a much more achievable goal that's going to set you up for success and set the company up for success in the long run. So people invest in people they know and trust. Your pitch is the first thing that happens to just generate that interest and get that conversation started. So there's a few things that go into it that are a foundation. First, what is your purpose? This could also be, what is your passion? This is your gasoline. This is what keeps you up late at night. This is what gets you up early in the morning. This is what has you problem solving all day long. This is what motivates you. This is the reason why you went out and started this company, and you're passionate about what you're doing. This comes out in different ways that isn't in words or pictures on your slide. This is an inflection in your voice. This is the way your body language is. It is all moving in that direction. And so we can still pick up on that on Zoom. We can hear the excitement that you have. And so keeping that in mind, that's the first thing that we're looking for is stamina, because like I said, this is a marathon and you're running it, and it's not for the faint of heart. Second, you want to eliminate red flags and confusion. If you are pitching to professional investors, chances are they've all lost money before. They've all been here, done that. As they listen to your pitch, they are looking for those red flags. They are looking to find reasons to move on to the next deal and why they shouldn't invest in you. And so this is where I tell, especially the early companies, don't try and know everything. Don't have this perfect polished pitch. We know as early stage investors that this deal isn't baked, that you have problems, you have challenges, you need help. That's why you're here. So be more transparent about that. It'll show your coachability as a CEO. It'll eliminate those red flags, and it will really help bring in those investors. Be authentic in how you pitch your deal. It doesn't need to be perfect. We know it's not perfect. Next is demonstrating competency. So we need to know that you're a competent individual to actually go out on this venture. I, as the investor, am investing in you. And so you can do this in a few different ways. One is I love appendix slides. So not every pitch is catered to a certain time or a certain audience. Being able to have those slides, my rule of thumb is never delete a slide ever. Just throw it in the appendix because it took work, it took effort, and you never know when you might need it again. So use your question period as a part of your pitch. It is all there. It is all there for you to use. You have the floor. So your pitch isn't just limited to usually 5 minutes or 7 minutes or 10 minutes. There's usually a question section that follows, which is the whole time that you have in front of those investors. And so use it wisely. Don't just keep one slide up, move around. Show that you know things, show that you're prepared. And those are little triggers that will help demonstrate competency and help the investor feel comfortable that you're the right person for the job to execute on this deal. You're the right person for them to write a check to. And if you do those things well, you will raise capital and you will be successful in being able to get back to doing what you do best, which is building your business. Because the reality is fundraising is a full-time job. So you have 2 full-time jobs that you have to do at the same time in order to be successful. So the goal is to get you back to work as soon as possible, doing what you do best, and that's building your company. All right, so now this is a shell, all right? This is not meant to be literal. How fast you choose to move through the slides is up to you. And you can go quickly or not. But as a rule of thumb, I like to think about your pitch as a good story that builds on one another. Also, we can thank Apple computers for the fact that we have the attention span of gnats. Everything is in pictures. If things don't come in the order that we expect them to come in, we're not listening to you anymore. We're thinking about the next thing. And so this order is actually meant to psychologically keep the investor focused on what you're saying. Now, the conundrum for entrepreneurs is the most important things come at the end. And usually entrepreneurs get hung up on the beginning and they rush through the end. So what comes at the end, you need to be able to have time for to hit those points, because those are the last things the investors are going to hear before they fill out their interest sheet. So timing is really important. So we start with usually a title slide or an overview slide, the problem, a couple of slides for the solution, the market, getting into the go-to-market strategy, because typically that's what we fund, is really that growth capital, that getting into market and accelerating the growth of the company, barriers to entry, competition, financials, team, deal, exit, traction, closing. Now, we're going to kind of go through the first 8 slides pretty rapidly. Just like with your pitch, I spend a great amount of detail on slides 10 through 15 because they are the most important slides you will pitch. The team, the financials here, the team is executing on the financials, which is why it's in that location. And then you're investing in the team, which is why the deal comes next. And then how I make money comes from the deal. And then there's a summary. So keeping that in mind as we go through. So let's talk about this. Overview slide. So I can't tell you how many pitches I've sat and listened to where I have no idea why the entrepreneur is standing in front of me. And It's because you do what you do every day and you do it really well. And me, I have no idea. You're just bringing me in. So I like to call this the overview slide. It's who you are. You're typically the CEO that's pitching, the name of your company, a quick little bleep on what your company does. You know, I'm a B2B enterprise platform. Great. I now know exactly what I'm about to listen to. I'm about to listen to a business-to-business software company. Super. And then why you're standing in front of me. How much capital are you raising? I don't need deal terms here. I just need to know, hey, I'm raising 500,000 bridge round on a convertible note, period. So then I know who you are, what your business is, and why you're standing in front of me. I have a great foundation as an investor to go forward of what I'm going to listen to next. Please include your name, your contact information on this slide, as well as your logo. But this is meant to be short, sweet, and to the point. The next slide. Now, look at this slide for a second. What do you feel when you look at this slide? Do you feel frustration? Do you feel angst? You feel like she's at the end? Okay, so once again, thank Apple, we think in pictures. You want to draw people in. The whole goal is to generate interest. So using pictures here is really important. Your problem should show frustrated people. They're frustrated with the solution that currently is out there in the market. You know, what is going on out in the marketplace? What's happening here that, you know, is not working? And so this slide here is the biggest problem slide for entrepreneurs, because let's face it, the reason why you went out and started your business is to solve this problem. This is your passion. This is it right here. You are making the world better because you're solving this problem. And honestly, as an investor, I could give a crap. I don't care. I probably know what the problem is. You know, I understand climate change. I understand these different things. Now, if you're in a nuanced cell processing company that's doing some interesting technology, yeah, I might need a little bit more explanation on the problem. But for the most part, I'm a smart person. I get it. 30 seconds on this slide. I watch entrepreneurs spend minutes on the problem talking about it. I don't care. I just want to know that there's a problem you're solving. That's it. That's all there is. So talk about the problem, be short and sweet, but then get to what it is. This is what I'm investing in. This is what's important. It's the solution. The solution is what matters. Take a couple of slides here. Talk about why it's better. What's currently being done that isn't working? Yours does. Show pictures. Show happy people using it. Whatever you can do to, once again, use those pictures, less words, bringing those people in to your solution and why it's going to be better than what currently exists in the market today. All right. So spend a couple of slides there and take care of that. All right. So now we get to one of my favorite slides. This is a red flag slide for me. So just know this. So if you come out there and you say your company, everyone in the world is your market, like everyone could be a customer. It's great. I've got this massive market. It's 5 billion. It's a massive market. Okay, you're a tiny little startup company. All right. I am great that the total addressable market is that large. It shows me that there's something to scale to and that you could actually be a venture-backed company. But what I actually really am looking for here is not just the total addressable market, but your target market, where you're starting. Who is that small slice of pie that is going to be those first drivers, that's going to be those first leaders that you're going to be able to spring on in sales to get that traction, to get to that total addressable market. So this slide for me demonstrates scale. It also, for me, ties directly into the financial projections later in your pitch, because it shows me you have methodically thought about how you grow this business. And so understanding, is it regional growth? Is it a certain demographic that's going to be your target market to start? Who is it? So break it down US, globally. You can talk about the market in multiple different ways. I really like to see this in some sort of pie chart with it broken down. So you have the total addressable market. And then as you expand and grow, you're going to start here, but you could scale up into these different areas. This is where it's important, because what makes a venture-backed business different than just someone starting a small business is the ability to scale and scale quickly. And then you take that little target market and you talk about how you go to market. So each slide, as you can see, is building on the next slide, keeping that investor laser focused on what you're speaking to. So what's your plan to grow these customers? How do you bring them in? What does your customer pipeline look like? Do you currently have customers on? Use logos, use those brands. Once again, we have an emotional connection to brands. That's why they're so important. So if you throw those brands up, those logos up, you're once again emotionally tying me to that pitch, the psychology of it. Is your product complete? Is it in the market, or are you still building out your MVP? What's the market research show? What's the feedback been? And then your sales strategy. Are you going to be going digital ads and selling on, through Facebook, or are you going to build out a sales team? And what does that look like? And who on your team has experience with managing that type of a sales team? Sales cycle, all of this. Take a couple of slides and talk in detail about your go-to-market strategy. This is really, really important. This is typically what we're putting our funding dollars towards. So the more detail you can provide here on how that's all going to work, the better off you're going to be. And then we go into barriers to entry. So what is that? What does that look like? Do you have IP? If you have IP, that's fine, great. Do you also have trade secrets? What is going to set you apart and protect you from your competition? What does that look like? Now, if you don't have those things, let's say it's a land grab opportunity, and sometimes it is. That's where your go-to-market strategy and the traction you have there and the people on your team are going to play such an important role on the execution and getting it done. So being able to call that out, once again, helps to eliminate red flags, which is something that we're doing. So, we're looking for. So just be sure to know that. And as you're interviewing investors to come into your business, see what types of expertise they can lend you that could add support to help, with some of these barriers to insulate you from your competition. All right, so competition. So it's funny. This is one of my favorite slides. And the thing that I find funny about it is that when I had my business, it was a land grab opportunity. I had no barriers to entry, and so I was deathly fearful of my competition, such in fear. But the thing that I realized after it failed and after I, went on, is that competition is actually meant to be embraced. Competition is awesome. One, they have defined a market for you. They have been out there trailblazing, making, having all sorts of problems. They have learned. You can learn from them. I mean, this is important stuff. Study your competition. See the mistakes that they've made. See what they did. See how you can avoid that pitfall as you go forward with your business. It provides understanding to the market. It gives you the ability to differentiate yourself and really set yourself aside as you market out your company. And they're potential acquirers, because as we have seen, most of these big behemoth businesses, they aren't out there doing entrepreneurship and creating these things internally. Some of them are. Most of them just buy up businesses, taking an existing product and throw it into what they're already doing. So make friends with your competition. If you're even able to bring on an advisor or two, a trusted advisor or two from your competition, now you don't have to give them everything. You can choose how you work with your advisors, right? But then you've now tied that competition in to the direct success of your business. If your business succeeds, they succeed because they have a little bit of stock in it. So, if you spread your love around and you think very methodically about how you could leverage this, competition is brilliant. Now, if you are a trailblazer and you are the first product to get to market in the area that you're in, God bless you. it is a tough slog, and it's going to be a red flag as you go forward and try to raise capital. But once again, you're just going to need to fall back on your team, what you're doing, and why it's going to be better. One thing about this slide, so using pictures, I typically recommend you use a quadrant. With your logo, of course, landing in the upper right-hand corner, because that's the way our eyes track. We track from left to right. So this gets into more biology than psychology, but we track from left to right, and our eyes end in the upper right-hand corner. So all we see when we look at a quadrant slide really is your logo, which is why you end there. Sometimes the logo can fit in the middle of the quadrant because you'll be focusing on the different areas. But if you think about a couple of different metrics you could choose, one could be price, one could be quality, and you could put your logos there. Another way to do it is if you make a chart, don't make it an eye chart, but people can do checks and X's. Make sure the checks are green, the X's are red, because once again, as humans, we identify with different colors in different ways. Don't put your company on the bottom. If you make a grid, put your company on the top, because once again, it's all feeding into the psychology of how that grid works out. And then keep in mind too, standard operating procedure. Human beings, as much as change is something that is consistently happening in this world at any given moment, we are so reluctant to change. So keep that in mind as you are building this out. So example, we had a company come through a business plan competition through the University of Washington a few years ago, and they created a soccer wall. And the soccer wall had different lights and things, and you could practice different kicks with this wall. And it was the first wall that was like doing this and that. But his competition was an actual wall that cost nothing. I mean, so think about that. What is currently happening? What are standard operating procedures that you are competing against in terms of human psychology to be able to get this product to market? Also a part of your competition. So from competition, we then go into financial projections. And so as I stated before, this ties directly to the market slide. Every single year, and typically we do 5-year financial projections, we don't put year 1, year 2, year 3 down on the bottom, creates a lot of confusion. We have no idea what year you're actually talking about. So please use the actual years at the bottom of this graph. Use a graph. I typically don't recommend in a presentation deck to have a chart with all of your numbers on it. Typically, the investors already have an executive summary that they're looking at, that they can look into all that financial detail that's there. So I like to see the scale. I like to see the hockey stick. As much as we joke about the hockey stick as investors and that these things are just projections and that they're not real, we get really uncomfortable when we don't see the ability for a company to scale. Also, know your numbers inside and out, and make sure, double, triple, quadruple check your numbers that they are correct. Because I have investors that sit in the room that literally look for mistakes in the financial projections, and they look to call out on, I mean, it's, every investor is different. So just make sure your numbers are dialed in and correct. The thing here that you need to understand is, as investors, we know these numbers are just what you're guessing they might be. But like I said, it ties directly into how you understand your market and how you've tried to build out scale. So keep the numbers as you grow into different verticals, different sectors. As you scale it up, you understand how they work. Next, don't tell me that they're conservative numbers. Actually, throughout your entire pitch, words like conservative tell me nothing. They're like nothing adjectives. They're just like little amplifiers that are like thrown in that are supposed to add fluff and glam and hype that actually are just really frustrating for me as an investor, because I learned nothing from what the word conservative is. If you have only 2% of the market taken into account in your financial projections, just say it's 2% of the market or 5% of the market or 15% of the market. Just say whatever it is. Don't use words like that. The more concrete information you can provide me as an investor, the better off you're going to be. As you continue to work your financial projections, let's just say you keep working your numbers. You've thought about your go-to-market strategy. You've got your different verticals. You've got your sales plan, how it's all working. You're building, and your line just keeps coming up flat. So it's not getting that influx. This is not the time to stoke the numbers and try and make it something it's not. This is a time when you as an entrepreneur should actually sit down and look at yourself and be like, maybe this just isn't a venture-backed business. There are lots of different businesses out there. Not every business is meant to go raise capital from private investors. So keep that in mind, that there's small businesses, there's businesses that people run forever. Those are not venture-backed businesses. So investors are looking for a return on their investment. And it's just a real conversation that you need to leverage your business advisors for and whatnot if you're not getting the results that you want as you go out and plan and prepare. All right, so then we have the financial projections. It shows me all of that. This is who is executing upon the financials. This is who is doing things day in and day out. This is my A team. All right, do not skip over this slide. I cannot tell you how many times I have seen entrepreneurs be like, oh, this is the team, blip, and they're gone. This is everything. I am writing a check and investing in you. I'm investing in you to execute and get it done. I believe in you to do this. Why are you here? What qualifies you? What gives you the expertise to go forward? Throw in those logos of your past experience. Who have you put around you that is smart and intelligent and knows the space that's going to complement and offset your weaknesses that you have? It's all about strengths and weaknesses here and how you build a team that's going to be able to have the right culture, work together, and run this marathon. This is really, really important stuff. Do not skip over this slide. If this is your first or second or third rodeo, fantastic. You've got experience. You've returned capital to investors before. You know the pitfalls. You know things to look out for. You know how to do this. If this is your first rodeo, this is where you need to leverage business advisors and seriously look at creating a board of directors and starting early. So there's two key things here. Business advisors are here to advise the business. They're here to help be your support as the CEO on decisions you can make. They're people that are trusted that you can go to when you're having a tough day and problems and you don't know how to solve them. This is where you leverage your business advisors. They are just not people you throw up on a slide and say, I have business advisors. You use them. Board of directors. These are the individuals who have a fiduciary responsibility to the investors. And so if you are raising capital, having some sort of operating board of directors is important. Collect your minutes, do this. If you are the only person on the board, and that does happen, that does happen in terms of your articles of incorporation and how that goes, you need to think about how you're going to do that. Who are those early investors that you're going to bring on? What is your plan for building out that board of directors and having that fiduciary accountability? It helps make the investors feel good. And then keep track of your minutes, keep track of different things. I have investors who have very strict guidelines along this. Going back to your advisors, these are people that have done what you've done. Okay, so I understand if you are in a special sector, let's say you're working with government officials and you need to have an advisor on, in the police department or in the water department or whatever. Yeah, those advisors are helpful that you can leverage to be able to work through the bureaucratic nightmare to be able to get your product to market. But when I'm talking about business advisors, I'm talking about people who have been there, done that, entrepreneurs that have started businesses. This is not your attorney. This is not your CPA. Okay, these people charge you money on a minute-by-minute basis, and they're going to tell you what you want to hear. Also, key thing about attorneys and CPAs that you need to keep into account here is that they are inherently trained to be risk adverse in every single thing that they do. And you as an entrepreneur are the complete opposite. Everything that you are doing is risky, everything. And so if you're going to them for advice on things and they're risk adverse, you're not going to get the proper advice. So please do keep that in mind as you seek out these business advisors. Look for people that are your investors that you can trust. Look for people that are serial entrepreneurs that have built and sold companies before, and then leverage them, use them, because what you're doing is tough stuff. It is not for the faint of heart. So they're very important people that circle out the entire team as you go out on this marathon and grow a company. All right, now we get to the deal. And I could talk about the deal forever. So once again, your attorney is going to tell you one thing with the deal. I highly recommend you go out and pool investors on what they would actually invest in before you go meet with your attorney and draft documents. Highly recommend it. Valuation, everything. So here's the thing, and I'll never forget one time an entrepreneur was like, wow, you're bold, but we're your market. So you have a market that you're out selling your product to. Now you're selling us on your company. So we're the market as you go out and pitch your business. So you have to know your market. You have to know what they look for, and the market chooses the value. So if you want to set an astronomical valuation, and I tell you, I see it out of the Valley all the time. I'm a new business. I got a 10 million cap on a safe note. I'm raising my first round. Okay, great. Well, good for you and good luck to you with those deal terms. That's very expensive for the risk that it is. And what gives you a $10 million valuation? Nothing. You have no customers, you have no IP, you have no protections, you have no business. So market determines value. If you want to go out on a high valuation, great, go do that and see how long you spend raising capital. If you want to be doing that the entire time. Now, if you want to bring your money in the bank and do that and get it done, then you're going to price it right. You're going to raise that capital. You're going to bring it in the bank. You're going to build out your capitalization table correctly. Because I tell you, if you do bring in dumb money at that 10 million valuation with no product, no nothing, when you don't hit your milestones and then you have to do a down round, that's a real fun conversation you're having with those really dumb investors that invested at that level. So it's like real estate. And I sold real estate in my previous life before kids. And I never thought I would use it in venture capital, but I use it when it comes to the deal. So if you ever gone and shopped for a house and you're looking and you find this beautiful house and it's in this great neighborhood and everything in this neighborhood's been selling in within a week, with multiple offers. But this house has been sitting on the market for 6 months. And you're thinking to yourself, God, what's wrong with that house? Something is wrong with that house. Maybe the plumbing is bad. Maybe the foundation is bad. Oh, maybe the neighbors are horrible, or something's wrong with the street. You start, thinking about that. Well, maybe there's nothing wrong with the house. And all that the real estate agent did to begin with was they overpriced the house. And so it just sits on the market because the market's not going to buy something that expensive. And then the house ends up selling for less than what it's actually worth. Same thing with your company. So price it right to begin with. Understand your capitalization table. As you look at your market, as you look at how you've built out those financials and what the different inflection points are going to be that you're going to need to raise capital, understand the total capital that you're going to need to raise and then plan accordingly. Leverage your business advisors, leverage your current investors, and make sure you have a proper plan with it. You go out to raise capital. Is all your paperwork done? Have you met with your attorney and actually have it drafted? I'm not going to write you a personal check. I'm writing a check into a business. I'm an investor. So make sure that's done. What are your deal terms and why did you choose them? So once again, going back to real estate. Deal terms are really important. And it's not just valuation. It's not just those big deal terms that we talk about. It's the nitty gritty stuff. What are the liquidation preferences? What is the voting rights? What are those fine line items that go into the deal terms? You need to read your term sheet and understand it. Most entrepreneurs don't. Their lawyer drafts it. Their lawyer drafts it in benefit of the company, and it's very lopsided. It's lopsided to the entrepreneur and all the benefits to them, but I'm taking my risk here. I'm writing you a $25, $50, $100,000 check. We need to make sure this is a marriage that's about to happen between you and this other person. How is it fair and balanced? So ask those proper questions on how the investor is affected when your attorney is drafting these documents. As you look at your deal terms and what it is, equity is gold. So we like equity. We like to be tied directly to the success of the business. Going back to real estate, equity is like buying a house. When you buy a house, what happens? You also have land. So you have the house and you have land. And when the market crashes, that land still holds value. And so for us as investors, it's really important. Then you have convertible notes. And I will tell you, convertible notes are a dime a dozen. It is one thing that is not standardized. And every single convertible note deal is different. So as you're working with your attorney, if you're going to be doing convertible notes, you need to understand the implications of it and the implications on your cap table. I call a convertible note like a condo with a view. So I've got some interest. I have a little bit of a discount going into the next round. I have a maturity date on the note, so it will mature. And so for me, it's a condo with a view, because even when the condo market crashes, my condo will still be more valuable than the lower level units because I have this gorgeous view. So it just provides a little bit more security for the investor, and they feel more tied into it. And then you have your safe note. And so for those that don't understand, a safe is a simple agreement for future equity. This for me is this is a bottom floor conversion condo. When the market crashes, it's done. There is no guarantee as an investor it's ever going to get converted. It's some sort of air promise that, yeah, I'm going to write you this check, and one day, maybe, if I'm lucky, if you do things right, I might have equity in this company. There might be a discount. There absolutely is no interest. And if I don't meet that funding requirement to convert it, the entrepreneur never has to convert. So the one nice thing about safe notes is they are standardized for the most part, but safe notes were meant to be a quick, simple, easy way for an entrepreneur to raise capital. And raising capital, I don't actually think should be simple, quick, and easy. It's a big deal. You are financially tying people in with you, and it should be thoughtful, and it should take into account how it implicates you. Now, one pitfall that I have seen, especially in the last 3 years, is that it's really cheap to get a safe note or a convertible note executed. I think seed equity documentation price has gone down a bit from some of the attorneys I've talked to, but when you're looking at Series A, B, this is expensive, paperwork that needs to be drawn up, even though the attorneys are just filling in blanks for the most part. Let's be real. But there's major implications on your cap table if you raise a safe upon a safe upon a safe upon a convertible note upon a convertible note upon a convertible note. You have to know your cap table. And I cannot tell you how many times companies come to us and their cap tables are broken. They're beyond broken between the debt, between the equity, and they've raised so many safe notes that the entrepreneur pretty much has nothing left at the end of the day. So you need to really think about your strategy and how it's going to benefit you. If you're going out for a friends and family round, a safe note's probably a great place to start. If you're trying to determine valuation and really get to that point, to be able to go out for a seed round, yeah, doing one convertible note could be a great way to go. But typically, we have gone away from the traditional methodology of raising an equity round. Oh, I didn't hit some of those milestones. I just need a little bit more inflection in cash, doing a bridge, in a convertible note, and then going back and doing an equity round. Those days are gone. So this can also really screw you up as you go to exit, because if your company isn't capitalized properly from the beginning, those buyers will look at it and they'll dismiss you because your cap table is such a mess. So this is really, really important stuff. Next, is your valuation actually realistic? Now, valuation is tough. I mean, there's so many things that can go into creating value for a company. The one thing that investors don't like hearing for your value of a company is your sweat equity. They don't like that at all. They're like, great, you went out and started this venture. You doing work for it is not count as equity. It may count as equity to you, and that's fine. But for an investor, no. Most. I'm not going to speak for all investors. So looking at your traction, looking at your customers, looking at your revenue, looking at your barriers, what are the big things you've accomplished to date? And that's how you create a valuation. Leveraging your current investors. What's that lead going to actually come in for? That lead that's going to be able to give you the resources that you need to support you and be with you round after round after round. What do they see as the value? Because typically if they're going in as a lead on a deal, they're a professional investor. So they know their stuff and they've been doing this for a while. So just keep that in mind, leverage those resources, and your company right out the gate is just not worth 10 million. It's just not. I'm sorry. I don't care what it is. What else here? I think that's what all I've got on that in my big talk there. Exit. Okay. So Q realization. This is not charity. I am not just giving you money because I want to feel good. Some investors do that and it's their charitable giving and that's what they do. Most investors, at least a part of my organization, we're doing it because we're investors and investors want to make money. That's why we do it. Also, key thing about making money is you make money. When you exit, all of your hard work comes to fruition and you get a reward. So what are you actually working towards here? One more thing, the ecosystem. The ecosystem is really important when it comes to exit because it's capital in, capital out. That's what makes the ecosystem work. And it's a very finite amount of people that actually choose to take their own private capital and put it into opportunities. Of all the people in the US who could do that, 3% do. That's it. And of those 3%, only 1% actually writes a check more than $25,000. So you got to be able to define your exit strategy. Be clear about it. What are the comps? What are people buying it for? Once again, going back to that competition and those relationships, you are planting seeds along the way. The big thing that I think is missed on exit is that it's just another stage of growth in the company. So you have inception and conceptualization, you have R&D, you build out your MVP, you've got product development, and then your go-to-market, and then your growth. Exit is the final stage of the company, and it's not something that happens in a day. It is something that happens typically over 12 to 24 months. And so it's very complicated. And are you going to IPO? If you're going to IPO, do you have your very first lease agreement? Do you have every single receipt that has ever been accounted for? Because you need audited financials, and every single document that's ever been done will need to be accounted for in an IPO, or you're going to screw it up and it won't happen. If you're going M&A, same deal. You've got to be able to have all of these things, your capitalization built out properly. You need to be able to be planning from this from the moment you start. And if you haven't been, then you should really rethink raising capital at all, because chances are you're probably not going to return it to investors. 70% of these companies fail that we invest in. It's a fact. So, what are you going to do to prepare to actually make it beneficial for you, for your team, and for everyone that believed in you along the way? This is important. Do not miss this slide. One other recommendation I would provide is creating an exit board of advisors. These are individuals who have exited companies before that can help you with some of the pitfalls along the way. All right, and then what I like to call, this is the last slide, what I like to call the traction slide. It also could be called the summary slide. This is everything that you have done with the company that is positive. So it's basically a recap of your entire pitch. It's the customers you have, it's the revenue you have, it's the patents you have, it's the team you've built, it's the team being right, it's press, it's accolades, it's awards, it's all the good things. This is the last thing the investor is going to hear before they fill out their interest sheet. And your goal is to just get people interested. So use logos, use things here, tie them in emotionally once again, and then thank them for their time. Say thank you, put up your logo, make sure your contact information is there. You can put up other accolades, logos, press awards, things on why you're the best deal, and just quickly thank them for their time. So a few more things here before I get into questions. I have just a couple more slides. So raising capital during a global pandemic, it's kind of fun, right? Everything's on Zoom. You don't have travel costs, so that's a benefit, right? So you're not traveling all over the place. You're not having those coffee meetings, but it has altered and it is different. So the key thing to keep in mind is moving quickly. You cannot spend time trying to figure out to make a decision or not, because if you do, you're going to get left behind. You need to find creative ways to generate revenue. So I understand you had this plan to go forward into the market, but now you might have to rethink that entire plan just due to the way industry is being affected. One example of this is a company we just funded called Keiretsu, and they have this little suture device that closes up wounds. And they were going to sell these into hospitals. And they're still planning on selling them into hospitals and doctors' offices for surgeries because it helps things heal quicker and provide better outcomes for the patients, lower costs for the hospitals, blah, 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 blah. Well, in March, when everything shut down, none of that was happening. And they said, oh crap, let's go to the consumer market. And it is literally blown up. They have sales on Amazon. I mean, when you wouldn't think a B2C business would work, theirs did. But it was quick thinking, a major pivot. They're still going into hospitals as hospitals are opening up. But now they have hundreds of thousands of dollars in revenue coming in through the consumer base. So you've got to move quickly, even though if it wasn't your core and what you started with to begin with. Because you're going to find that pipelines will begin to slow. So if those pipelines are slowing, what pipelines are growing? Because it's all different. It's all shifted. And everything that we thought we knew is now changed. I do highly recommend having 12 months of cash on hand. Preserve, preserve, preserve. Cut, 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 cut costs. Cash is king. I mean, we have an election in 4 days, and I feel like the entire country is holding its breath one way or the other, whatever comes out of this. So, how much cash can you keep on hand? Apply for grants. Look for them within your state. Look for them nationally. Bring in that non-dilutive funding. It's good for you. It's good for your investors. If you do have happy customers, see if they'll pay in advance. And then once again, keeping in mind, yes, you had this path you were going down, but market determines value. And if you want to sell, you could hold firm on what your pricing is, or you could alter it, start bringing that cash in the door. And as you gain traction, be able to grow and increase costs. So just keep that in mind as you go forward. So this is a little bit more of a reiteration of it for kind of near to midterm. Once again, thinking quickly. Negotiate with your vendors. I mean, see if they will actually, put you on a different payment plan if you have some sort of consumer product or you need different costs. I mean, people understand that things are odd right now and they want your support. So work with them, communicate with your investors. It's such an important tool that most of us don't do when we get scared and we don't want to talk about what's going on. Focus on revenue generation, government support, mentioned all of that. So what does fundraising look like? I don't know. I mean, I thought it was going to go down. We're still waiting for our Q3 numbers to come out, but I mean, I think globally Q3, we did over 20 million in funding, which is crazy. So here we are in a pandemic. There is a lot of cash out there, and there are people looking to put it places. And especially with what happens with the stock market, it is a benefit to us here in the secondary market and the private markets, because people will be looking to put their cash elsewhere than the public markets. So keep that in mind as you go forward. Term sheets are being renegotiated. We have seen valuations come down due to this. So be realistic as you go out the first time, and be coachable and willing to take feedback. And then probably the biggest thing that's going to come from this is we're going to just see a shakeout in the startup community. The companies that are hanging on by a thread, they're going to fail and they're going to close. And so, you know, the ones that, you know, choose to move quickly, pivot, have the right team in place and can execute are the ones that are going to come out on top. So just keep that in mind. And then lastly, forget all the reasons why it won't work and believe in the one reason that it will, because you're an entrepreneur and that's what you do.